Stock Market Basics, 9 Tips for Beginner. Here's an explanation for how we make money. News shows, Hollywood films, and TV all assume that you know what the stock market is and how it works. Everyone knows that you can make a lot of money in the stock market if you know what you're doing, but beginners don't often understand how the market works and exactly why stocks go up and down. Here's what you need to know about the stock market before you start investing. What is the stock market? Stocks, which are also called equities, are securities that give shareholders an ownership interest in a public company. It's a real stake in the business, and if you own all the shares of the business, you control how the business operates. The stock market refers to the collection of stocks that can be bought and sold by the general public on a variety of different exchanges. Where does stock come from? Public companies issue stocks so that they can fund their businesses. Investors who think the business will prosper in the future buy those stock issues. The shareholders get any dividends plus any appreciation in the price of the shares. They can also watch their investments shrink or disappear entirely if the company runs out of money. The stock market is really a kind of aftermarket, where people who own shares in the company can sell them to investors who want to buy them. This trading takes place on a stock exchange, such as the New York Stock Exchange or the Nasdaq. In years past, traders used to go to a physical location, the exchange's floor, to trade, but now virtually all trading takes place electronically. When news people say, "The market was up today," typically they are referring to the performance of the Standard & Poor's 500 or the Dow Jones Industrial Average. The S&P 500 is made up of around 500 large publicly traded companies in the US, while the Dow includes 30 large companies. These track the performance of the collections of stock and show how they fared on that day of trading and over time. However, even though people are referring to the Dow and the S&P 500 as the market, those are really indexes of stocks. These indexes represent some of the largest companies in the US, but they are not the total market, which includes thousands of publicly traded companies. Of course, you'll need a brokerage account before you start investing in stocks. As you're getting started, here are 8 more guidelines for investing in the stock market. How to invest in the stock market, 9 tips for beginners. Buy the right investment. Avoid individual stocks if you're a beginner. Create a diversified portfolio, be prepared for a downturn. Stay committed to your long-term portfolio. Keep investing over time. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. If you're analyzing a company, you'll want to look at a company's fundamentals, earnings per share, EPS, or a price-earnings ratio, PE ratio, for example. But you'll have to do so much more: analyze the company's management team, evaluate its competitive advantages, study its financials, including its balance sheet and income statement. Even these items are just the start. Katie says going out and buying stock in your favorite product or company isn't the right way to go about investing. Also, don't put too much faith in past performance because it's no guarantee of the future. You'll have to study the company and anticipate what's coming next, a tough job in good times. 2. Avoid individual stocks if you're a beginner. Everyone has heard someone talk about a big stock win or a great stock pick. What they forget about is that often they're not talking about those particular investments that they also own that did very, very poorly over time, Katie says. So sometimes people have an unrealistic expectation about the kind of returns that they can make in the stock market. And sometimes they confuse luck with skill. You can get lucky sometimes picking an individual stock. It's hard to be lucky over time and avoid those big downturns also. Remember, to make money consistently in individual stocks, you need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. An alternative to individual stocks is an index fund, which can be either a mutual fund or an exchange-traded fund, ETF. These funds hold dozens or even hundreds of stocks. And each share you purchase of a fund owns all the companies included in the index. Unlike stock, mutual funds and ETFs may have annual fees, though some funds are free. 3. Create a diversified portfolio. One of the key advantages of an index fund is that you immediately have a range of stocks in the fund. For example, if you own a broadly diversified fund based on the S&P 500, you'll own stocks in hundreds of companies across many different industries. But you could also buy a narrowly diversified fund focused on one or two industries. Diversification is important because it reduces the risk of any one stock in the portfolio hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket. The easiest way to create a broad portfolio is by buying an ETF or a mutual fund. The products have diversification built into them, and you don't have to do any analysis of the companies held in the index fund. It may not be the most exciting, but it's a great way to start, Katie says. And again, it gets you out of thinking that you're going to be so smart, that you're going to be able to pick the stocks that are going to go up, won't go down, and know when to get in.